this is an equity fund which is following an index. It's a passively managed fund. ELSS. It's a tax saving fund, and it is following index as uh, benchmark index, and the fund return is slightly lower than the benchmark. So they have similar risk profile, but the fund return is lower than the benchmark. Similarly, you can find other funds which will have a slightly higher ROI than the benchmark, and that's what we want: more return, lower risk. And so, fund performance is one of the most common factors which almost everybody gets to look at, and this is the easiest to judge factors. So, you are looking at trailing returns 5 years, 3 years, 10 years, and you're trying to compare it with the other funds. But that is just the start. That is a good place to start, but that is not everything. There is more to the fund performance than just the number that you see in 3 years or 5 years or 10 years performance. So, two funds can give you the same kind of return, like 21% each for 3 year period. They have generated a CAGR of 21%. Now, how do you judge which fund is better? For that, let's move on to the financial ratios. So there are eight major and most popular ratios, which almost every fund manager, every mutual fund advisor should be looking at while selecting the mutual funds. So return alone is not enough to judge a mutual fund performance. You also look at the risk that you took. So if one fund is more risky but giving the same return as the other fund, which is less risky portfolio, there is something wrong with it. And obviously, the less risky portfolio is better because it offers you more confidence that you will achieve that kind of return in future also. So, what are the factors? Standard deviation is one which is available for almost everything. Duration is available for bond funds or fixed income securities. Jensen's alpha will be available for both. Beta, yes, Sharpe, Sortino, Trainer, and information ratio. So we'll look at each of these ratios one by one, what they mean and what they indicate. First thing, let's have a look at the standard deviation. So standard deviation simply shows you how volatile the security performance is. So on the left, you see the small cap fund over a period of 6 months, almost a year. It's about 6 months. So over a period of 6 months, you see the return has gone from 0% to minus 6-7%, and from that to 10% also. A very volatile performance. But on the left side, you have a money market fund, which is pretty consistent with the return. It continuously starts going from 0% to 4%. But if you compare, also there is less volatility, more assurance that your money is going to grow, but the rate of growth is going to be low with the money market fund. With the small cap fund, there is a possibility that your investment may be reduced